Hi, everyone. Thanks for joining Mark in today's podcast. One question first, before starting the video. What if I told you the United States just spent billions of dollars trying to break China's grip on the most important resources in the world? And it might actually make China stronger. It's not an easy question, so I will take a while to break it down. Right now, there's a hidden war over the materials we use every single day. Not oil, not gold. Far more important. We're talking rare earths like lithium, cobalt, and graphite. These power our phones, electric cars, advanced weapons, and even the entire green energy future. And here's the scary part. China controls almost all of it. So the US finally woke up and launched a massive multi-billion-dollar plan, drawing in government money, private investment, emergency powers, literally everything it could locate. On paper, it looks like a bold move for independence. But what if this entire strategy is already cracking? What if the plan designed to escape China's control is actually a trap? And if it fails, China doesn't just win, it wins completely. Because that isn't just about mining. It is a global chess match over who controls the future. In the high-stakes world of global power, control over resources is everything. For decades, one nation has quietly and methodically cornered the market on the essential building blocks of the modern world. China has a quasi-monopoly, if not 100% yet. Now, the United States has finally woken up to this critical vulnerability. Washington is rolling out its most ambitious countermove yet. There isn't a single snappy name for it. Still, when we add it all up, between Department of Energy loans, Defense Production Act investments, and other federal and private funding, it's a multi-billion-dollar gambit to break free from China's chokehold. It's been hailed as a decisive move, a declaration of economic independence. But what if this grand strategy, this multi-billion-dollar line in the sand, is not only at risk of failing, but is already showing signs that it could unintentionally pave the way for China's ultimate economic victory? What if the very plan designed to secure America's future is in fact a trap? We raise these questions again to illustrate how the US is desperately trying to survive. This story isn't just about stockpiling minerals. It's a story about a fundamental misunderstanding of the opponent, the battlefield, and the nature of this new economic war. And we're about to uncover the startling truth behind America's high-stakes gamble and why it might be backfiring in the most spectacular way imaginable. To understand America's new strategy, we first have to understand the sheer scale of the problem. For over 30 years, while the West was focused on globalization and just-in-time supply chains, China was playing a different game. It was a long game, executed with strategic patience and massive state-backed investment. Their goal was simple: dominate the entire value chain of critical minerals, from the mine to the magnet, and they've succeeded beyond anyone's wildest imagination. Let's be clear about the numbers, because they are staggering. Today, China processes roughly 90% of the world's rare earth elements. But the real chokehold isn't just what they dig out of the ground. It's in the midstream, the refining. China controls around 74% of cobalt refining, about 65% of lithium processing, and almost 100% of the graphite used in batteries. Think about that. Even if the United States, Australia, or any other country mines the raw ores, it almost always has to send them to China to be transformed into the usable materials its industries depend on. That wasn't an accident. It was the result of a deliberate, decades-long industrial strategy, and Beijing has poured vast sums of money into this effort. A recent report revealed that China has deployed over $120 billion in outbound investment into critical minerals since just 2023 alone. That gives Beijing a terrifying amount of leverage, which it has used as a political weapon. In 2010, they cut off rare earth exports to Japan amid a territorial dispute. More recently, between 2023 and 2025, they rolled out a series of export controls on key minerals like gallium, germanium, and a growing list of rare earths, sending shockwaves through global supply chains. These actions served as a brutal wake-up call. The West realized it was dangerously dependent on its primary geopolitical rival for the very materials needed for its economic and national security. It was in this atmosphere of crisis that America's new strategy was born. Faced with this crisis, Washington is fighting back with a complex multi-pronged strategy that amounts to a massive public-private initiative. It isn't one single project, but a flurry of activity powered by billions in government funding. The Department of Energy, for instance, has made billions in loans available and recently announced another $500 million in funding to boost domestic processing and recycling. The Department of Defense is using its authorities under the Defense Production Act to invest in domestic mining and magnet manufacturing. It isn't just the government buying and hoarding minerals. It's an attempt to send a powerful demand signal to the market and de-risk private investment. For years, investors have been terrified to fund new mines and refineries outside of China. They knew that as soon as their expensive new facility came online, Beijing could flood the market with cheap state-subsidized minerals, drive prices into the ground, and bankrupt the new venture. It's a classic predatory pricing strategy that has worked time and time again. The new U.S. approach aims to solve this by providing loan guarantees, direct investment, and other support. This gives private companies the confidence to build. The goal is twofold. First, to create a strategic buffer and shield U.S. manufacturers from the supply shocks and price volatility that China can create at will. If Beijing suddenly cuts off exports, American factories won't immediately grind to a halt. Second, and more importantly, it's designed to kickstart a non-Chinese supply chain finally. In theory, this provides the revenue certainty needed to unlock private financing for mining and processing projects. It's meant to be the first step in building a completely new, secure, and reliable supply chain from the ground up. On paper, it sounds like a brilliant, market-driven solution, a powerful countermove in this global chess match. But the reality is proving far more complicated and perilous. The first and most glaring problem is one of simple arithmetic. While several $billion sounds like a lot, it's a drop in the ocean compared to the resources China has deployed. As we noted, recent analysis shows Beijing has spent over $120 billion on overseas mineral projects since 2023 alone. America's strategy, as significant as it is trying to compete with a multi-decade, multi-hundred billion dollar state-directed industrial machine. This colossal investment gap has created an even larger gap in expertise and infrastructure. As one expert put it, the U.S. is trying to undo 30 years of strategic monopolization in 24 months. China has spent years building relationships and institutional experience in resource-rich countries. The U.S. is trying to play catch-up to a network built over a generation. But the most critical flaw in the American plan, the one that analysts point to as its potential Achilles heel, is its focus. While recent initiatives are correctly targeting midstream processing, the sheer scale of the challenge is immense. A stockpile of raw materials is of limited use if you don't have the capacity to separate them into individual elements and then transform them into the high-purity metals and alloys needed for advanced manufacturing. The United States, by and large, does not have this capacity at scale. These processing facilities are incredibly expensive to build, face significant environmental and regulatory hurdles in the West, and require immense technical expertise that China has honed for decades. It's a technological and engineering barrier that a few $billion cannot overcome overnight. So while the U.S. plan might provide a temporary cushion and build some new capacity, it doesn't solve the core dependency. It buys time, but it doesn't instantly create the sovereign capability to turn rocks into F-35 components or EV motors. Critics argue that without an even more aggressive, full-spectrum industrial policy, it's like building a granary without owning enough fields or mills. You have a reserve, but you still can't make your own bread. And it is this critical flaw that opens the door for China's countermove, the one that could turn America's defensive strategy into an offensive victory for Beijing. The backfire scenario that keeps strategists up at night revolves around China's most potent economic weapon, its ability to manipulate prices. Imagine this. Encouraged by U.S. government loans and support, Western investors finally take the plunge. They pour billions into developing new lithium mines in Australia, cobalt projects in Canada, and maybe even a new rare earth processing plant in Texas. It takes years. They navigate regulatory hurdles, build the infrastructure, and finally, they are ready to start producing. And then, Beijing makes its move. Having watched these new competitors sink massive, unrecoverable costs into their projects, China could decide to open the floodgates. Using its vast, state-subsidized network, it could dump enormous quantities of minerals onto the global market at prices far below what the new Western facilities can sustain. Global lithium prices, for example, have plummeted by 80% before due to Chinese market actions. Suddenly, the new Western mining and processing companies would be decimated. Unable to compete with the artificially low prices, they would face bankruptcy, and all that new Western capacity the U.S. strategy was meant to foster would be wiped out. The result? China would not only reassert its monopoly, but it would do so having forced its main competitor to foot the bill for a failed experiment. Beijing could then move in and buy up the distressed Western mining assets for pennies on the dollar, strengthening its grip even further. It isn't just hypothetical, it's a well-documented strategy. The second way the plan could backfire is subtler and concerns allies. In response to criticism that its approach was too nationalistic, the U.S. has been trying to build a coalition. It launched the Forum on Resource Geostrategic Engagement, or FORGE, a successor to the Minerals Security Partnership, which brings together over 50 countries to coordinate on diversifying supply chains. One plan after another. Perfect PowerPoint presentations. But this flurry of activity highlights a fundamental difference in approach. The West is attempting to build a secure supply chain through a complex patchwork of alliances. China, meanwhile, has spent decades building a brutally effective system based on direct state-to-state investment and infrastructure deals. For a resource-rich nation in the global South, the choice can become complicated. The American-led initiatives might involve navigating a web of different partners and uncertain price mechanisms. China, in contrast, often offers a straightforward, albeit potentially predatory deal. We will build your port and processing plant, and in return, we get the rights to your minerals. By creating market uncertainty, the U.S. may inadvertently make China's simple, direct model look more attractive. So, are America's efforts doomed to fail? Not necessarily. Analysts agree that government investment is a necessary step to provide a buffer and encourage private industry. It is a form of strategic insurance. The grave danger lies in mistaking that insurance policy for a comprehensive strategy. The current funding buys time, but it's what America and its allies do at that time that will determine who wins. To truly challenge China's dominance, the United States must move beyond just initial investments. The consensus among experts is that a much broader, more aggressive, full-spectrum industrial policy is required. First, this means a massive, sustained investment in midstream processing. The real war is won or lost in the refineries, separation plants, and magnet-making facilities. It requires more than just loans. It requires direct government support, regulatory reform to fast-track permitting, and workforce development. Second, Allied coordination needs to become deeper and more binding. The Forge initiative is a good start, but it needs to evolve into a true trading bloc with enforceable, coordinated price floors and shared investment standards to counter Chinese price dumping. This bloc would need to act as a single, massive buyer to create a market large enough to rival China's domestic demand, thereby avoiding a scenario in which allies compete against each other. Finally, this strategy requires a level of long-term thinking and strategic patience that Western governments have not historically demonstrated. China's dominance was built over 30 years of consistent, state-directed effort. Rebuilding a secure supply chain will be a generational project, requiring a stable policy that can survive changes in political administrations and market fluctuations. The geopolitical chess match over critical minerals is one of the most important and least understood stories of our time. It will define the 21st century economy and the global balance of power. If you want to keep exploring the deep dive topics that shape our world, make sure to subscribe and hit the notification bell for more analysis like this. America's multi-billion-dollar push is a monumental gamble, a bet that it can break free from a dependency decades in the making. But it's a bet made on the premise that it can outbuild and outmaneuver a deeply entrenched rival. By underestimating the strategic depth of China's control over processing and by creating a system that is vulnerable to predatory pricing, the United States risks more than just wasting billions of dollars. It risks creating the very market conditions that could allow China to bankrupt emerging Western competitors, consolidate its monopoly, and achieve an unshakable economic victory. The backfire has not happened yet, but the mechanisms are primed. The U.S. has bought itself some time. The critical question remains, will that time be used to build a real, resilient, and sovereign supply chain, or will it merely be a pause before the trap is sprung? It appears that the U.S. has little chance of winning the game.